If you're still running the old default plan, buy and hold 60-40, and just stay invested, you might be playing last decade's game. Charlie Munger spent his final years saying, in plain language, that the future would be harder, more crowded, less forgiving. And if returns get tighter, your mistakes cost more. So here's the central question. If the easy tailwinds that made mainstream investing work are fading, what replaces autopilot without turning you into a full-time trader? Let's define mainstream investing the way most people actually live it. You buy a broad basket of stocks. You add bonds to smooth the ride. You keep contributing. And you tell yourself you're not going to react because time in the market beats timing the market. That basic approach built a lot of real wealth. And the reason it worked wasn't just discipline. The world around the strategy helped. For a long stretch, the backdrop was friendly. Rates generally moved down over time, which supported both stocks and bonds. Valuations had room to expand. Globalization helped push costs down and growth up. And a lot of investors got used to a pattern where just keep buying felt like a cheat code. Now, that's the part people miss. 60-40 wasn't a law of nature. It was a product of a specific regime. It worked because bonds often acted like a shock absorber when stocks fell, and because the whole system had these big tailwinds that made the long run feel smoother than it really is. What this means is mainstream investing was never truly set it and forget it. It was set it and let the system do the heavy lifting. And Munger, late in life, kept pushing against the idea that those freebies would keep showing up. Not because he thought investing was dead, but because he thought expectations were wrong. One quiet change is saturation. When too much money crowds into the same safe trades, you get a different game. The big index names get endlessly bid up because they're the default. The same bond exposure gets treated like a universal hedge. And the average investor starts paying for safety through lower future returns, even if nothing feels risky in the moment. That's the trap. Crowding doesn't always look like danger. It can look like comfort. Another quiet change is inflation risk. And I'm not saying hyperinflation or end-of-the-world stuff. I mean the normal kind that makes cash buy less and pressures policymakers to stay tougher than investors want. In that kind of environment, bonds don't automatically play the hero role. Sometimes they don't offset equity pain the way people expect. And now the classic 60-40 assumption, bonds will save me, becomes less reliable. Then there's the harder future point, which is really the core of Munger's warning. If the next decade gives you lower, choppier real returns, you can't afford sloppy behavior. When expected returns are high, a lot of mistakes get covered up. When expected returns are lower, the same mistakes become permanent damage. And here's where buy and hold gets misunderstood. Buy and hold is not a market strategy. It's a behavior strategy. It only works if you can actually hold through long, boring, frustrating stretches where nothing seems to happen, and through ugly stretches where everything feels broken. Most people don't fail because the market drops. They fail because they abandon the plan mid-regime. They sell, they wait, they miss the rebound, and then they come back late. So if the old backdrop is weaker, the fix isn't more predictions and more hot takes. The fix is structure. A plan that assumes tougher conditions and still keeps you investing like a professional, not reacting like a human with a phone. So what do you do when you accept the premise that autopilot is weaker? The goal is not to beat the market each month. The goal is to build a plan that survives inflation, volatility, and long flat stretches, so you can stay consistent while other people self-destruct. Rule 1 is you stop treating time horizon like a personality trait. A lot of people say, I'm a long-term investor, like it's an identity. But the second things get loud, they trade like a day trader. So you need to turn patience into a system. Automation. A fixed schedule. Fewer decision points. Your default action should be boring and repeatable, because under stress you will not rise to your goals. You will fall to your rules. Rule 2 is you separate return money from stability money. This is the biggest practical upgrade you can make. If every dollar is in the same pool, then one life event can force you to sell your long-term assets at the worst time. That's how people turn normal drawdowns into permanent damage. So we need two jobs. money that compounds, and money that keeps you from being forced to touch the compounding engine. Now, let's talk about bonds for a second because this is where the 60-40 story gets people in trouble. The old assumption was simple. Stocks are your growth, bonds are your cushion. But regimes shift, correlations change, and in inflation pressure, bonds can behave very differently than people expect. What this means is you can't treat bonds as a magical hedge. You treat them as one tool in a broader stability plan. Sometimes they help, sometimes they don't. So your safety can't rely on one relationship staying true forever. That leads to the regime-aware habit. This is not forecasting. We're not trying to guess what the next year brings. We're preparing for multiple outcomes so you don't get trapped when the world changes. And the cleanest way to do that is a 3-bucket structure that replaces the old default. Bucket 1 is defense. This is runway liquidity. The boring stuff. The cash-like buffer that covers your real life so you're not a forced seller. Defense is what lets you hold your long-term assets through a bad sequence. Bucket 2 is base. This is your diversified compounding engine. Broad exposure, long-term, and you leave it alone between review dates. Base wins because it keeps working while you're living your life. Bucket 3 is optional offense. Small, capped risk, where the upside matters but the downside doesn't break you. This could be a concentrated idea you truly understand, or a skill investment that raises income. The rule is the cap. Offense is allowed to be wrong. Now you stress test the plan before the market stress tests you. Ask 3 questions and answer them in writing. 1. What would make me sell? Not what should, but what actually would. Job loss. Big bill. Panic. If you can name it, you can plan for it. 2. What drawdown can I live with and still stick to the plan? If your plan requires courage, it's not a plan. It's a hope. 3. What headline would hijack my behavior? Because the headline itself isn't the problem. Your reaction is. Next is the real edge most people never build. Rebalancing rules. You rebalance on a calendar, or you rebalance with bands, not with mood. That way you're trimming what ran and adding to what fell without turning it into a debate. Then you install an information diet. Fewer inputs means fewer urgent decisions. The market will always give you something to worry about. Your job is to protect your attention so you can execute. Think about investing like a garden. You water on schedule. You protect the roots in bad weather. And you don't dig up the plants every day to see if they grew. And watch for the mainstream trap in new clothing. Cash pays now can turn into permanent waiting. Hype themes can turn into crowd risk. The point isn't to avoid trends. The point is to avoid being emotionally recruited into them. So when people say Munger's warning sounded pessimistic, this is the reframe. He wasn't saying don't invest. He was saying don't expect the old freebies. And if you build structure, the harder era becomes manageable. The death of mainstream investing is really the death of autopilot. When returns get tighter, structure beats optimism, because structure keeps you from forced moves and emotional moves. If you want more long-term frameworks like this, subscribe. And tell me in the comments, what's your weak spot right now, defense, base, or rebalancing discipline?